So you've probably heard the term Forex floating around. It's this massive world where trillions of dollars move every single day. And today, we're going to pull back the curtain and break down exactly how it all works. Let's get right into it.
First things first, just look at this. This isn't some building on Wall Street. The Forex market is this huge, decentralized global network. It's like a planet-wide financial nervous system, connecting banks, institutions, and yeah, even individual traders.
And the scale? I mean, it's just mind-boggling. We're talking about over $6 trillion changing hands every single day. To put that into perspective for you, that's more than the entire yearly economic output of most countries, all happening in just 24 hours. Wild.
So what exactly is this massive arena where all this action is happening? Let's get a really clear definition.
Okay, so at its core, Forex, which is short for foreign exchange, is basically the global marketplace for swapping national currencies. And because it's decentralized, it has no headquarters, it literally follows the sun around the globe, which means it's open for business 24 hours a day, 5 days a week.
And you know, these features are what really make Forex stand out. Its enormous size means there's incredible liquidity. You can almost always find a buyer or a seller instantly. Plus that 24/5 schedule and the fact that anyone with an internet connection can get involved, that's totally different from your traditional stock markets.
All right, so we get what the market is, but how do you actually, trade in it? Well, it all starts with learning the language of the market.
This is really the best way to think about it. When you trade a currency pair, you're not just buying some abstract thing. You're basically making a bet on one country's economy against another's. So if you think, say, the European economy is going to do better than the US economy, you might buy the euro against the dollar. It's a tug of war.
And this is the actual thing you trade, a currency pair. Currencies are always quoted in pairs, like the euro versus the US dollar, written as EUR/USD. The price you see tells you how much of the second currency it takes to buy 1 unit of the first one.
Now, knowing how to read a quote is absolutely crucial. The first currency is called the base, and it's always equal to 1. The second one is the counter. So if you see USD/JPY at 100.00, it just means $1 can buy you exactly 100 Japanese yen. See? Simple as that.
Okay, so your profits and losses, they're measured in these tiny little units called pips. A pip is just the smallest possible change in a currency pair's price. For most pairs, we're talking about a move in the 4th decimal place. Now I know, it sounds tiny, but trust me, depending on your trade size, those little pips can add up to some very real money.
And finally, you might be wondering, how do brokers make their money? Well, it's through something called the spread. There's always a tiny difference between the price you can buy at and the price you can sell at. That small gap, that's the broker's fee for making the trade happen.
So, we've got the lingo down. Now, what do you actually need in your toolkit to analyze the market and make decisions? Let's take a look.
Generally, traders see the market through 2 main lenses. First, you've got technical analysis. That's all about looking at charts and past price patterns to figure out when to buy or sell. Then there's fundamental analysis. This looks at the bigger picture, economic news, interest rates, politics, to understand why a currency might be moving. The really successful traders, they usually use a bit of both.
And this right here is so important. This is the responsible way to approach trading. It's not about just diving in, it's a process. First you learn, then you build a solid, written plan. Then you practice that plan with fake money until it's second nature. And only then do you start small, with real capital you can afford to risk.
This quote really hits the nail on the head. Success in this game isn't about finding some super secret complex formula. It's about having a straightforward, solid plan and then having the mental toughness, the discipline to actually follow it, day in, day out.
Which brings us to our last section, and honestly, it might be the most important part of this whole thing, mastering risk, which, when you boil it all down, really just means mastering yourself.
Let me be crystal clear about this. Your number 1 job as a trader is not to make money. It's to protect the money you already have. If you focus on preserving your capital first and foremost, you guarantee that you'll be around to trade tomorrow and long enough for your strategy to actually pay off.
Now you're going to hear about a tool called leverage, and it is a classic double-edged sword. On one hand, it lets you control a big position with just a small amount of your own money, which can seriously amplify your gains. But, and this is a huge but, it works both ways. It will amplify your losses just as fast, and you have to treat it with a ton of respect.
So how do you handle all that risk? You use your defensive toolkit.
These 3 things are non-negotiable. First, you always determine your position size before the trade, risking only a tiny fraction of your account, like 1 or 2%. Second, you use a stop-loss order to automatically get you out if the trade goes bad. And third, you use a take-profit order to lock in your winnings, every single time.
But you know, when it's all said and done, it comes down to psychology. You can have the best strategy in the world, but if you can't control those 2 big emotions, fear and greed, you're just not going to make it. Mastering your own mind is really the final boss of trading.
And hey, don't just take my word for it. Check out this stat. Research shows that up to 80% of success in trading comes down to psychological factors, not just technical know-how. 80%. That tells you everything you need to know about how important the mental game is.
So we'll end with this thought right here. The Forex market is always going to be there, providing opportunities. That's a given. The real question isn't about the market at all. It's about you. Do you have the discipline to follow your plan, to manage your risk, and to truly master your own psychology?